everybody to the February market update with Jolene Moore. We started this back at the beginning of COVID, and we're so glad we've continued it because I think this is some of the best information that you get as an overview of what's going on in the market every single month. I'm Cindy Bishop with Cindy Bishop Worldwide. And before I introduce Jolene, I just want to go over, make sure your chat's up. She doesn't mind if you unmute. And this video link will be on her instructor page at cindybishopworldwide.com. So for those of you that don't already know Jolene, she's the Vice President and Senior Home Loan Consultant with Main Street Home Loans. She's based out of Fairfax. She's also a top-notch producing lender. And really one of the most sought after for her care and diligence. Jolene is very good with her customers and very good with the agents that she teams up with those consumers. So in addition to being a top-rated mortgage lending specialist, she's a value trainer with us because she doesn't just do lending stuff with us. Jolene is a gifted business building trainer. And I don't say that lightly. I think she's magical. If you can't listen to a business building event with her and actually take away something that will improve your business, then you just didn't pay attention. She's just that good. I've learned so much from her. So with no further ado, Jolene, take it away.
Thanks, Cindy. Very kind. Appreciate it. So thanks again, everyone, for hopping on. I love that the amount of people we're seeing on these are growing as we continue to do it. So, so it's enjoyable. So thank you. And I learn a lot myself when I put this together. So it's good for me. And, you know, like Cindy said, you can put, if you have any questions or comments or anything that you want to talk about, put it in the chat box or unmute yourself. You know, I do love interaction, like Cindy said, because it can be challenging to just sit here and talk and not have the feel of, you know, people are listening or learning or, you know, any kind of engagement. So I'm always open to that. So we're going to do the market update. So I always start with where rates are. So most of you, I mean, there's a good amount of you that have probably been on these before or been to one of my other classes. So every week I send out a video kind of updating you on things that are happening. And one of the things that happened in January is we saw a big jump in interest rates. You know, it kind of started the first of the, you know, the very first day, that business day of January 3rd, we started seeing the rates, the market, you know, because the mortgage interest rates are based on the bond market. So the bond market started really reacting to potential rate increases, the inflation, but also the idea that the Feds were going to be starting to sell their mortgage-backed securities, which they bought during the past 2 years to help keep rates low. The anticipation is they were going to start selling those in March, but it actually started happening in January. And that's partly what also created the volatility in rates. And we saw them jump up. You know, we probably started January at 3.125. And by the end, we are probably at 3.75 or so. Maybe 3.875. So it just kind of depends on the price, the credit score, you know, loan program, all that kind of stuff. The other thing that has been announced, and I just did a video on this last week as well to remind you, is that also it was like maybe January 3rd or 4th, the Fannie and Freddie decided to announce that they're making changes to the loans, to interest rates on loans between 647,200 and 970,800. So which in our area is called high balance conforming. So we have, you know, conforming loan amounts, which is below that 647,200 mark. And then we have the high balance, which is this tier here. And then we have jumbo, and jumbo is above the 970,800. So what they decided to do is change the pricing that they're charging for the rates in this bracket right here. And we priced that out, and ours are going into effect. So technically they announced that it's going into effect on April 1st. But what happens is when we close a loan, we have to then deliver it to Fannie and Freddie. And it can take us a few weeks to be able to deliver that loan. So we have to give ourselves time to be able to get the loan delivered to them before April 1st. So we have put into place that is not going to happen, or that is going to happen for us as of March 15th. So any loan that closes after March 15th is going to have the rate increase that Fannie and Freddie have put into place. which when we look at it, it could take the loan from 3.75 up to 4.25, 4.375. So it's about a half a point or more rate increase in those loan amounts. So what I see happening in that scenario is, one, we may be looking at doing first and second loans to try and keep the loan at that conforming loan limit so that we avoid the hit that they've put into place for those loan amounts. We may be doing more jumbo loans because jumbo loans don't have that hit as well. So we may be looking to try and do a jumbo loan to avoid the increase in the interest rate. So there's going to be some more creative ways of us handling loan programs going forward to try and help our clients stay in the lowest, price interest rate possible. So that's something to keep in mind for you as you have clients getting pre-approved and making offers on properties, of knowing what that's going to look like for them, and do they need a little bit more time on closing, because when you do a second loan, you can't close in 2 weeks. You need a little bit more time. I did do one in 21 days, which was pretty good. Jumbo loans also take longer. Most jumbo loans, you're going to need that full 30 days to close. So those are some conversations that you definitely want to learn and know before making offers of if they're going to be doing anything, and not assume it's a conventional loan because the loan amounts in our, our conventional pricing. We might have to make some adjustments to and how we do things. So something you want to definitely keep in mind. This is relative to conventional, meaning FHA and VA is not having this impact because that's not controlled by Fannie and Freddie. That's controlled by the government, another entity within the government. So this is for conventional loans, which are the Fannie and Freddie products. Anyone have any questions on that and impacts that they're going to have regarding that? Okay. All right. So then what I also try to do is just share some market information. So I looked at, end of the year for last year, basically. And then also December of 2021, because, January, it takes a little longer for it to come out. So we did see a decrease in home sales in December of 2021 versus 2020. But if we look historically, December is usually a slower month. So, I'd say it's probably still a very strong sales month. Inventory was down, as we all have seen. And as we've seen, January started out with a bang. With offers and increase, going back to what we saw last year. We're seeing escalation clauses. We're seeing waiving of all the contingencies. It's definitely hit very hard in January. A lot of that is because our inventory is so low. We have a lot, we had one of our highest lead months in January that we've had in several months. But the problem is there's not a lot of loans for all those leads, people that want to buy our homes, I'm saying, to be able to go and purchase. So that's the biggest challenge right now is inventory. So, going after your database, really, focusing on trying to get as many listings as we can is going to help, the dynamic of all these escalation clauses and multiple offers on the properties. The average sales price increased by 5%. And then year to date, when we look at this, and a lot of you probably have seen this, but homes sold by the amount of homes sold increased by 17%. The loan volume, the sales volume, the sales price increased by 23%. And then the average sales price from the year to year increased by 5%. Now, what some of that I think is what it actually closed for versus, what it actually was listed for. So cash sales, we're still hovering about 11 to 13% each month is what I saw in 2021. So December ended up at 13%. VA loans as well, they hover between 10 and 11%. I'd love to see the VA loans increase. I hate that, I had a client that I was just pre-approving who's going to have to go conventional and not use their VA eligibility because so many listing agents don't look at VA loans as favorably. So it makes them, have to go a loan product that is not the best product for them. And that's really unfortunate. So I would just, try to educate all of you, as well as anyone that that VA loans are probably the easiest loan. Like I had a loan last month that was a VA loan, and I found out the seller and the buyer were friends. The seller paid off a credit card for the buyer prior to going under contract. In any other product, that would have been an issue because that's an incentive. It could have been non-arm's length transaction, all that kind of stuff. VA allows sellers to pay off debt. So all we had to do was an addendum to the contract showing that seller paid off that contract and the amount that they paid, and we were fine. So there's so much flexibility with the VA loan and qualifying that it's just unfortunate that it's viewed in such a unfavorable way. So I hope that that shifts over this year, because it really, I mean, it's this, like we were just talking about the rate increase, this client's looking at a sales price, it's going to put them over that 647 loan amount. They're going to have to go conventional and take a higher rate than they would if they were able to go VA and give them a better interest rate, not have that rate increase because they're not instituting that increase. So I'll get off my soapbox, but definitely think about it. Some other things that have come about is consumer sentiment is down, meaning that there's a lower the amount of people that think right now is good time to purchase, is being really impacted by the increase in sales price, and I think a lot of young buyers are also concerned with the affordability for them. The U.S. Census Bureau says home ownership rate was unchanged, meaning so most of the different age groups, the amount of people that were owning in that didn't really change much. The other thing that I did a video recently on was about Fed rate. So I've heard a lot recently about the rates being increasing. They're saying, oh, the Feds are going to increase interest rates in March. I got to get into a loan before then. The reality is, and I did this in a video, is what the Feds do not control long-term interest rates. So the Feds control short-term interest rates. So that's, if you have a home equity line of credit on your home, it's connected to that. If you, what the banks charge each other to lend to each other, that's what that Fed fund rate controls. So what controls ours, as I was saying earlier, is the bond market. So when the Feds say that they're going to raise their rates 4 to 5 times this year, whether or not that happens or not, we'll see. They're increasing, like I said, if you have a home equity line of credit or, some like credit cards, car loans, those types of things, we're going to see those start to move up because those are short-term rates that are more connected to what the Feds are doing. But what the Feds are saying is obviously they're making this change because of the fear of inflation. They see the wage increases going up very high, so they're concerned. So they're trying to battle that inflation and the impact it can have on our economy. So there's obviously, we saw an impact based on what they said and are anticipating in January, which is why I think our rates moved up sooner than everyone was thinking because of all of that. So when they raise it, doesn't mean our rates went up 0.25%. It just means that the market could have some volatility associated with it. They could have some reaction, but it's not in direct correlation. So it's just something to keep in mind and help educate your clients on relative to when they hear about the Feds and anything connected to that. So I saw it on or Anna saying that you can't waive appraisals in VA loans. I agree. I understand that. I've also had clients do an addendum saying that they're agreeing to that they, and I know if you went to court, it's not going to, potentially stand up. But, I know that there's clients that are trying to work through that with additional addendums to be able to still make that happen because of that. And if buyers agree to pay cash over the appraisal, they can get around low VA appraisal. Right. Yeah, exactly. But, the reality is too, okay, so I've said this before, is I don't see VA appraisals come in very low very often at all, or any more than I see on conventional loans. And the reality is with a VA loan is if they do think they're bringing the appraisal come in, they have a tidewater rule, right? So they then notify us to notify you as agents saying, okay, it looks like this appraisal might be coming in low. Can you send us an additional comps? So then you have yet another option, ability to give them comps to be able to keep that appraised value high. I had a client, a situation last year where we were doing a conventional loan. It came in 76,000 low. We switched to VA. The listing agent let us switch. We did a new appraisal and it came in at sales price. So there's so much variance with different appraisers, and it's not VA versus conventional. It's just individual appraisals. So, and what comps they're willing to use. So it's just something to, to keep in mind. All right, so this is something I wanted to share relative to Barry Habib, who is a pretty well known in the mortgage industry of making kind of predictions relative to what they see that, he sees happening with interest rates and all of that. So it's like looking at, back in this time period where Burns and Voeckler was the Fed chair. We had inflation of about 7 to 14%. Rates were in 12 to 18%. That's the other thing. I'd love for people to realize that rates have always, have been a lot lower than they are right now. So even going into the 3 or 4%, we're still, much lower. The Fed fund rate, the Fed fund rate right now is at 0, and the Fed fund rate is in this route. So basically they raised their Fed fund rate from 11 to 20%. Inflation went from 14% to 5%. Mortgage rates went from 18 to 12. And then we went into a recession and the stock market went down 30%. Same thing with Alan Greenspan. We went from inflation to 1.5 to 3.5. Mortgage rates were about here. They raised the Fed fund rate. We saw inflation come down to 1%. We saw rates come down 3%, to 5.5. And the stock market, lost 50%, and we went into a recession. So right now we've gone from 1.75 to 7%. These are where our interest rates were. This is the Fed fund rate. They're anticipating it. So they're anticipating that the inflation should drop after they raise this Fed fund rate we were just talking about. So should decline as inflation declines interest rates. So there's what he's saying is he thinks in 2022 or the end of this year or 2023, we could see rates come down again. If you see the same trajectory, because every time they have raised the Fed fund rate in order to fight off the increase of inflation, we have then seen rates come back down. And then we've seen the potential of going into a recession. So that's something just to think about and keep in mind. When I heard this, I was like, what? There's no way rates are going to come down again. So who knows? He's had some good history wise. When you look at what he said, it's panned out and it's ended up happening. So we'll see how things go forward. But it's just something I wanted to bring to your attention that we could see some shifts in rates again, maybe in 2023. All right. So, okay. So there was a Sherry. VA should definitely be good. Yeah. Thank you, Alex. I've sent in comps under Tidewater, and it was obvious that VA appraiser completed appraisal without reviewing new comps. We use my husband. He went offering paying cash over appraisal. Yeah. It's definitely, it's challenging for sure. Even when you do offer to make up that difference. And the thing is that, whether appraiser has made it or not, I had a situation just a couple of days ago, they were definitely willing to look at it. We had no additional comps to give them. They brought the appraisal in 4,000 low. So relatively speaking, we were in good shape with that. So we were happy with where it came in, based on when you do the Tidewater, you have no idea what that difference might be. So we were, happy to see that it was only 4,000. And then, honestly, when you get a bad appraisal, when you don't agree with an appraisal on the conventional side and you want to challenge it, it's very rare that you're going to get an appraisal changed on the conventional side as well when you challenge. So it's nice with VA that you get to give it to them ahead of time rather than after the appraisals come in, because once it comes in, they have a hard time making a change. I don't know why it is, but it's hard to get them to budge. Here's something else relative to appraisals that's come up a little bit recently too, is remember when we can only use comps based on those that have closed prior to us ordering the appraisal. So even though the appraisal may not have been done, and there's been a comp that's settled like the week after we've ordered the appraisal, but we didn't get the appraisal till the week following, they are not going to be able to use that comp. So if you know of a comp that could be settling, that could really help your deal, you need to let the lender know. And so give them the strategy of when to order that appraisal, because once the order date is submitted, that's the date that the effective date of the appraisal. So it's again, more communication with the lender to make sure that that's handled right. So great news, some really good news. Self-employed guidelines are back to pre-COVID rules. So for the past, year and a half, almost 2 years, we have had to put self-employed borrowers through the ringer for Fannie and Freddie loans. It has been challenging for them and challenging for us. We've had to get so much documentation. So now all we have to do is go back to getting tax returns. We have a system that we use to run the tax return through, and it tells us what the income is based on, the adjustments and deductions that they've expensed on the credit report, on the tax return, and that tells us the income that we can use. If the self-employed person has been in business for more than 5 years, we only have to use one tax return. If it's less than 5 years, we have to use the average of 2. So something to keep in mind as well regarding that. But we were all very excited. They just announced that last week that Fannie and Freddie went back to pre-COVID rules for self-employed. So that is really good news. We also have a new builder program. It's a 2-1 buy down loan program. So if you're interested in that, reach out to us and we can talk to you more about that. Another change the Fannie and Freddie made when they increased the rates between that bucket I just showed you of 647 to 970, they are also increasing rates on second homes. The second homes, unfortunately, went up even higher than it's more in line now with investment property rates as opposed to where before second homes were closer to primary rates. Their interest rates were, they are now closer to investment properties. That we do have an investor that we're putting into place that's not going to be going to Fannie and Freddie, that's going to be helping us to allow us to offer a lower rate than what Fannie and Freddie are going to do. So I'm happy about that. So if you have clients that are looking at second homes, reach out to us and we can see how we can help them with the other investor that we have. We also have long-term interest rates, like we're talking about, rates have been increasing. I know it's fearful, especially when you're going to buy new construction. What does that look like? What are rates going to be when the home's ready, 3, 4, 5, 6 months? So we can look at that too. And we have a long-term rate of 6 months and 12 months. So if that's something that you have a client that needs to talk about, let us know and we can talk to them. The other thing that's shifted, and I just thought about and I wanted to bring it up because for a long time it was not allowed. But Daca, if you have a client that has the Daca status that keeps them here in the United States, they are now allowed to use FHA loans and conventional loans. And so that's very exciting too, because that was something that shifted that I was not a fan of, and I'm glad that we now have the ability to help them be able to purchase homes. All right, so tips from last month. Let me see. So self-employed change is great. A builder buy down is great too. Oh, thank you. And what does that mean? New builder 2-1 buy down mean? It means that, like, let's say the rate is 4%, we can buy the rate down, to like 3%, even 2%. It's usually like in those increments. You still have to qualify at the higher rate, but the payment will be lower for like a year and then goes up the next year and then it goes to the final rate. So it's kind of a step process to allow them to go in with a little bit lower payment initially, but we can talk through that more if you have clients that are specific, that want to look into that. Something else I wanted to bring up, we can do loans where only one borrower has a credit score and the co-borrower doesn't. So that's a change Fannie and Freddie made a few years ago. Just wanted to bring that back up. So we had a client recently that we got pre-approval for. The borrower had a great credit score. The co-borrower does not have any credit. So we were able to still keep them on the loan, be able to use their income and do the loan. It had no negative impact on them, even though that co-borrower did not have a credit score. And Daca is, somebody asked me to explain that. Daca is for those children that come to the country with no documentation, and they're allowed to stay in because their parents brought them in, or however they got into the country as a child, and it didn't have a visa or green card or whatever. They have a special status for those children, and in the past they have not been able. Now that they're adults, they still can get to stay in the country based on that status, and now they're able to purchase and get a mortgage as well. Government loans above 640, 7,200, we now can go down to 640 credit score. We were, during COVID, that has increased the credit score limit on that. So it's now back down to 640, which is good. And Refi Now program is a program we just did for a client last month. And it was really helpful because when we got their loan, he had started out trying to go do a refinance with the credit union. They denied him. He didn't really know why. So he came to us and we looked at it, and it was because his debt to income ratios were too high. They were higher than the normal guidelines. This particular program allows us to go to a higher debt to income ratio, and it gives us some more flexibility with the program, with loan to value and things like that. So we were able to get him refinanced, save him money, even though he wouldn't have fit into the traditional conventional guidelines because of this new Refi Now program. So if you have anyone that's looking to refinance, that's something we can talk about. We also have an investor who does model homes as a primary residence, and you can rent the model home back to the builder for 12 months. Most of the time when you do something like that, it's going to be considered an investment property, but this particular investor will still consider it as a primary even with letting you rent it back to the builder for 12 months. They also, this particular investor also allows us a shorter amount of time. Like I have a client that was looking to buy a home. She'd only been getting alimony for 2 months. Fannie Mae and Freddie Mac require 6 months. So I wasn't going to be able to use that income to allow her to qualify to the price range she wanted to purchase. This particular investor allowed us to use the alimony, even though it only been 2 months. Now, this investor does require larger down payments and things like that. So fortunately, she fit into all of that. So it's not going to work for everybody, but it does allow us to have a little bit outside the box thinking than Fannie and Freddie has. So it's something that we can talk to people about and see if it works for them. We've also been, really, like I just had a client win a contract last night. There was 8 offers on it. They escalated, waived all the contingencies, and we're closing in 14 days. So we have the ability to close quickly if we need to help people win and be successful with the contracts, because I know it's really tough right now. So if there's something you need, let us know. The other thing that we recently did is we had a client that went to Navy Fed Credit Union, and Navy Fed was going to make them do it as an investment property, which they did not agree with. They were well in, and this is the thing I'll tell you about credit unions and some of the larger organizations, they don't always do the due diligence up front. So they'll, I might tell them, well, we have to do it this way. Then they go to credit union. The credit union's like, oh, no, we can do it this way. They start the process. And then about halfway through, they're like, oh, wait, no, we have to switch it. Now we have to do the other way. That's what happened in this situation. And we were able to then take back the loan, close it in 10 days and get it done. So it's just, just know that if you work with us and have a client working with us, we're going to do all of our due diligence up front because we don't want anything to change during the process. So when somebody's, if we say something and they go to somebody else and they say something different, I'm not saying that we're perfect and we know everything, but what I'm saying is there's a good chance that something's going to change during that process. I had another one just happen with Bank of America. So it's just something to keep in mind and help educate your borrowers when they're working with a local lender, with a loan officer you trust versus some of those large organizations. They may not do all that due diligence up front. So something to keep in mind. All right, Ashok also can work permit workers get a first-time home buyer loan program. They would have to have like an EAD card. If they have an EAD card, which is the card that allows them to work in the country, or a visa, we have to have something like that, or because when you have Daca, you have an EAD card, and then there's a designation on that work card that allows you and tells us what your status is. So that's something we can look into. All right, anyone have any questions on any of this and any of the other, I guess kind of, I don't think I asked about this, but anyone else have any questions about these? All right, so I have a survey for you guys. So I'd love for you to put it in to the chat or unmute yourself. But do you think a pre-approval letter is more powerful with a higher sales price than what is being offered? So for an example, if you have a listing and they've escalated their offer to $525,000, and they send a letter that says they qualify for $950,000. Do you think that, I'd love to hear how you view that. Is that make a difference? Is it viewed more valuable because you say, oh, wow, they can actually qualify for more than what they're offering? Does it change to where, oh, well, now we can try to counter and ask them for more money? Like, I'd love to know what your thoughts are on that. If anyone would unmute themselves or put in the chat box, I'd love to hear from you.
I think, hi, this is Soma.
Yes.
I think to the seller, it's when we have higher, like loan than the actual market price of that property, I think I don't know, I think maybe it's right or wrong, but the seller helps the seller to think that this is like a good loan and could be like quick and smooth because the person is qualified more than this. On the other hand, they might think that they might, like raise the value of the property. So I don't know.
Yeah. And when I asked this question, I want you to come from it as a listing agent. So because somebody said, what depends what hat you're wearing. And so I wanted your thoughts on the listing agent side, how you would think, which is what you referenced, Selma. So I appreciate that. Is how your thoughts would, how that would be viewed for you.
I look at it, this is Sherry Young, I look at it as a positive, and I tell the sellers, it's better to have a buyer who's being conservative than a buyer who's spending their last nickel buying your house, because there's less chance of something going wrong.
Right.
But
Okay.
especially in multiple offer situations, sellers can tend to look at that as, especially if there's another competing offer that's at a higher price than their offer. But, maybe that's to the buyer's benefit, then they don't lose out on the house.
Right. Okay.
So
All right.
it can hurt them in terms of maybe the seller comes back higher, but maybe in a competitive thing, they would get the house even though they didn't bid the highest or put an escalation. So it's a double-edged sword. It's tough.
I know. I appreciate that though. It's something that, so let's see what everyone else says. So Tricia said, depends what hat you're wearing. One represents the seller. You think they can afford more and can increase their offer. Right. Also depends on appraised value, but this is not relative to what they're actually offering, just showing that they could qualify for more than what they may have offer. And Nadine, yes, it impresses the seller that the buyer is very qualified, does not, and it does change their negotiation strategy. I think it will be difficult to negotiate a lower offer. I agree. Yeah. And that's where it's like, I just recently had a situation where someone mentioned that the listing agent was going to choose an offer that had the same offer price, because their letter said they could qualify for well above what they were offering, and thought that must be a better loan than the one who said exactly what they were offering on their letter, even though that borrower could qualify for more, just didn't indicate it on the letter. So that's what I wanted to get some feedback on your thoughts. So I appreciate each of you expressing, and that's where I think there's some challenge, but I think like Sherry just mentioned, in a multiple offer situation, it could help separate you from other offers. So it's good feedback. So thank you all.
So
All right,
what
so
would be I'm sorry for the interruption. What
No,
would
go
be
ahead.
the best to follow, like to have the pre-approval letter higher than the marketplace, or just adjust it based on the marketplace and get renewed pre-approval?
Well, and that was kind of my question, because, what I usually do is if someone's offering, there's the list price and then what they escalate to, I do the letter to the escalation amount. And so to show that they can go to that amount, but then, it's kind of like what everyone has mentioned, is that in a seller's eyes, that can be it can look more favorable if like they're offering 925, but I say they're approved up to $1 million. It gives them the ability to feel comfortable that this isn't like, right on the edge, and they may not qualify if, anything shifts or whatever. So, but yeah, okay. Well, thank you all so much. If there's any other questions, thank you, Sherry. I appreciate it. Is anyone else have any questions or comments? Love to hear from you. If not, have a great rest of the day. Enjoy February. We'll see you in March. If you guys need anything, we're always here to help. And, we'll, like